Hi everybody and welcome back to this channel. Today we're going to talk about the portfolio update, how we've performed, and let's get starting right now. As we expected in last video, the huge gains that we've had in January of this year were not sustainable. We've seen a drop in our portfolio performance, a 4% drop roughly, nothing to worry about. It's totally normal, and to be honest, I expected a bit more downside. Maybe it will happen in March. You can never know. One thing that was really surprising in February was that our eToro account has been cut in the eToro algorithm. At the beginning of the month of February, we had 7 followers. Now we have 35. So that's a big move for our account. I can even say that we have 4 copiers. 4 people. I know one person, so 3 people that I don't know that follow our portfolio. So hi guys. I suspect that the only reason our portfolio got so many views, I can show you the graph, so many views, is that we've had a beautiful January month in terms of performance. So I suspect people, when they create their account, they want to copy some other people. Our portfolio was maybe at the top list of the people recommended to copy. So yeah, that's my guess. I understand a little more how the eToro algorithm works. If you have a strong performance during 1 month, you will get much more followers the upcoming months. And at the beginning of March, because of the performance drop, I've had like 0 followers, 0 views. You can see at the graph that the views of our account have decreased significantly. So yeah, that's how it works, and that's how it will work in the future, I suppose. So in February, we've seen a drop in price in most equities, and this happened for various reasons. For example, we've seen some geopolitical risks with China, some profit taking. We've seen a big drop in Chinese equities. We've seen some profit taking, same with Meta platforms. We've had some issues with ChatGPT. The price of Google has dropped 10%, something like this. We've seen a decrease in oil price, so a drop in price in Occidental Petroleum. And I'm not worried at all. I have almost 40% of the portfolio in cash, so I welcome lower prices. Please go down so I can buy more beautiful businesses at good prices. Please drop more. And this is exactly what I've done in February. The only thing I have bought was Occidental Petroleum. I bought more of this company. So now this represents about 15% of the portfolio. I think that's a very good business backed by Buffett because he liked the stock, obviously. I said I wanted to wait for a price at $60 per share. It reached $60 per share, so I bought, and it reached even lower, 58, so I bought at 58. Oxy presented their latest results that I can show you right now. Basically, their operations are good, and their main focus is creating value for shareholders now. They will reduce debt and do buybacks. They said they wanted their debt level to drop below $25 billion so they can start buybacks, and that's exactly what they have done. Now buybacks will be a bigger focus for them. They bought back $3 billion worth of stocks, and with a market cap around 50 billion, this represents roughly 6% of their market cap, in buyback. And they increased their buyback program, so they will buy back $3 billion more of their shares. So again, 6%. If we get 6% every year for 3, 4, 5 years with a debt reduction, that's good news. Regarding Google, it seems that there are many problems, many new threats The media says that Google is at risk. They said that business is a worse business than it was in the past because of the chat GPT and AI and all this investment that will reduce earnings, increase costs for the company if they want to compete with these chatbots. You have some regulatory issues. You can argue that Google is being hunted by all these threats, and Meta platforms is hunting because it is investing in all these things, killing TikTok in inch by inch, defending itself against Apple privacy issues with pricing, with Advantage Plus, all these better ad policies. What is puzzling is that even with the media talking bad about Google right now, at the same time, you have Lilu buying the stock at this moment. For those who don't know who Lilu is, he's a protege of Charlie Munger, and he's called the Chinese Warren Buffett. So if the Chinese Warren Buffett is buying Google right now, at the same time that the media is saying bad things about Google, you'd rather be on the side of Lilu. So even with these scary headlines, Google is at risk, etc., I will continue to buy the stock if it drops around $85 per share or lower. Now it's at 90, so I'm just waiting for the moment. We now turn to Alibaba, which saw a huge increase in price in January and a huge drop in price in February. That's geopolitical tensions, that's risk aversion towards Chinese equities. It has always been the case for years now, so we are used to it. The results of their latest quarters have dropped. These are good results. Despite all the issues, tech crackdown, regulation, lockdown, competition, delisting threat, geopolitical headwinds, the revenue has not gone down. If Alibaba manages cost-cutting measures, the earnings can go up. It's just that there is a Chinese hate right now. Nobody wants to invest in Chinese equities. That's very risky for many, many reasons. There is kind of a wall of worry, and I suspect that if we get good news, everything will get lifted. For example, a few days ago, we've seen some data showing strong recovery in the Chinese economy. So that's good news. Speaking of Alibaba, let's talk about Charlie Munger, my hero, my god, because he has talked in February at the Daily Journal meeting about Alibaba. He said that this investment in Alibaba was one of his worst mistakes, and he was seduced by the internet retailing, the internet aspect of this retailing business, but he said it's just a retailing business. There is too much competition, and it's hard to be great when you have too much competition. And maybe that's why Manish Prabhurai has thought too, because in the past he had a position in Alibaba and he sold to buy Tencent via process. He thinks Tencent is a better business than Alibaba. Tencent is much more compliant regarding the Chinese government, and they've adopted rules for years in line with the government, what they wanted. So maybe I will change for Tencent or process at a point in time, but not right now because I'm still studying the businesses. Charlie Munger also talked about semiconductors, and in my watch list I have Micron. I want to be really cautious about Micron because these semi companies have to invest most of their earnings in the business into the next generation to have more earnings, to invest everything, to invest in the next generations. So it brings poor return on invested capital, and that's not the kind of business I like. So Charlie Munger was cautious about investing in these businesses, but Manish Prabhurai invests in Micron, Lilu invests in Micron, and Munger approves of it. So if I buy some Micron shares at an attractive price, it will be a tiny portion of my portfolio because Charlie Munger doesn't consider it a cinch. Another company that I've recently added to the watch list is Louisiana Pacific, LPX. In a few words, that's a cheap company that is buying back its own share at a very high rate, like 15%, last year 15%. This year, most of its cash flow goes into buybacks, and Berkshire Hathaway has bought the stock recently. Now it has a P ratio about 4 or 5 for this year, and I'm just studying the business right now. If it can continue to buy back more share, what it can do, what's the business about, the competition, all these things. Okay, let's go to what I'm reading now and what I've read recently. I've finished the Constellation Software shareholder letters. I like them. Mark Leonard is a very good capital allocator, and the returns they had 20% per year, 30% per year for over 10, 15 years. That's really, really great. I wish they explain in more details what they do, like the business related things, the software industry, etc. They did not go into details about what they exactly do because they don't want to disclose to the competitors their strategy. Because I didn't fully understand the business, it's a pass for me, and I will not buy the stock, especially since it has a high valuation. I've also read this book, How the World Really Works by Vaclav Smil. It's one of Bill Gates' favorite author. I loved this book. It's a scientific book about the world, the civilizations, agricultures, carbon emissions, the different scenarios of the world for future decades. It's quite easy to understand, and it talks about many subjects. For you, I have 4 fun facts that I guess you didn't know about. First, the energy cost of tomato is higher than the energy cost of chicken. You will not have more information about it. The book illustrates in details the different steps of the cultivation, etc. Second, about ammonia. I did not know that ammonia was so important as the dominant nitrogen fertilizer. If you cut ammonia from the world, almost half of the population will die because of shortage of food. Third, about cement. In 1980, China produced around 80 million tons of cement. 40 years later, in 2019, Chinese output is about 2 billion tons of cement. And there is a stunning fact. In just 2 years, 2018 and 2019, China produced nearly as much cement, so around 4 billion tons, as much cement as did the US during the entire 20th century. So that's a big number, and that's exactly the reason you see China as the country with the most complex system of roads, rapid trains, airports, big numbers. In only 2 years, you have the entire cement production as in an entire century for the US. That's big news. You have some risks about this, about all this hyper growth, but that's still amazing. And the final fun fact is about CO2 emissions. In 30 years, between 1989 and 2019, we increased global anthropogenic greenhouse gas emissions by about 65% in the whole world. And now, if you go in detail, the developed countries such as US, Canada, Japan, Australia, and European countries, they did reduce their emissions by about 4% in 30 years. And now if you compare to the Indian emissions, the Indian emissions have quadrupled in 3 decades, and the Chinese emissions rose 4.5 times. So yeah, I think that's the way to look at things. There are more people going out of poverty in these developing countries, getting more wealth, better standard of living, and that's completely normal. And we will see how it goes in the next decades to see their investment in renewables. If they do, how they will react, because if they lift everyone out of poverty, what is the next step? We will see. Another book that I've read and finished a few days ago was The Investment Checklist by Michael Chern. Sorry if I don't say his name correctly. Basically, it gives an overall view on what to monitor when you analyze a business, when you're doing some research on a company, like the industry, the financials, the management, capital allocation, the culture. And I also learned something interesting about JP Morgan. I know it's a great business, great management. You have Jamie Dimon, its CEO, going to Berkshire Hathaway annual event. There was a chapter about how management of a good company has to think independently and remain indifferent by what others competitors are doing right now, because there may be fads, short-term profits that you can have, but it can damage your long-term view, long-term culture. And you have this example. Before the subprime crisis, Jamie Dimon, CEO of JP Morgan, did not follow his reckless competitors as they chased poor quality mortgage-backed securities in search of higher fees. At the time, most of JP Morgan shareholders complained that Dimon was being too conservative and that he passed up the chance of making millions of dollars in profits. However, when the financial crisis of 2009 put some of his competitors out of business, Dimon was one of the few CEOs who managed to both weather the storm and strengthen his business during this time of distress. Shareholders will often attempt to influence managers to maximize short term profits. The best managers always maintain a long term focus. That's great. And that's it for today. I have started to read Seth Klarman's shareholder letters, so I will tell you in the next video what I've learned from them. I'm sure it will be very interesting. Warren Buffett, when he was asked who he will give his money to, if he wanted somebody else to manage his money, he said three people: Lee Lu, Greg Alexander, and Seth Klarman. So it's very interesting to see, to enter the brain of Seth Klarman, how he thinks, etc. We will see. I will tell you. I see that our community in YouTube is growing. Now we have 19 subscribers. That's a huge hit, and we see hyper growth in the process. So good news. Okay, see you in a month for the March review of our eToro account, and I wish you a good day and bye bye.